You've been lied to about money your entire life, not by your parents, not by your teachers, but by a system so deeply embedded in our financial infrastructure that questioning it feels almost unpatriotic. Let me ask you something. When was the last time you held a dollar bill and actually thought about what it represents? Not what it can buy, what it is. Because here's the uncomfortable truth. That piece of paper in your wallet, it's not backed by anything, not gold, not silver, not oil, nothing. It's a promise from a government that's currently drowning in debt to the tune of over $33 trillion and counting. And yet, we work our entire lives accumulating these promises. We save them. We invest them. We plan our retirements around them. We measure our entire net worth in these government IOUs. Meanwhile, there's something else happening. Something the mainstream financial media barely whispers about. Something your financial advisor probably hasn't mentioned. Central banks around the world are quietly dumping dollars and stacking physical gold at a pace we haven't seen in decades. Not hundreds of tons, not thousands. We're talking about a systematic, coordinated shift in how the world's most powerful institutions are storing wealth. The People's Bank of China, the Reserve Bank of India, the Central Bank of Russia, Poland, Singapore, Turkey. Even countries you'd never expect are loading up on physical metal like they know something we don't. And here's what should terrify you. They do know something we don't. They have access to data, to economic models, to geopolitical intelligence that you and I will never see. And their actions are screaming one message: get out of paper, get into real assets. But let's back up, because I know what you're thinking. Gold? Really? Isn't that what my grandfather talked about? Isn't that old school thinking? And that's exactly what they want you to think. See, there's been a decades-long campaign to make you believe that gold is a relic, that it's a barbarous metal with no place in a modern portfolio, that stocks and bonds and real estate are the only smart investments. But ask yourself this: if gold is so irrelevant, why are central banks buying it in record quantities? Why did global central bank gold purchases hit their highest levels in over 50 years? Why are the world's most sophisticated financial institutions moving away from the very paper currencies they print? The answer is simple. They see what's coming. Let me paint you a picture of what's actually happening right now in the global financial system. And I'm not talking about conspiracy theories or doom and gloom predictions. I'm talking about documented, verifiable facts that are playing out in real time. For the first time since World War II, the US dollar's dominance as the world's reserve currency is being seriously challenged, not by one country, by dozens. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems that bypass the dollar entirely. Saudi Arabia, a country that has priced oil exclusively in dollars for nearly 50 years, is now accepting yuan for oil sales. Think about that. The petrodollar system, the very foundation of American financial hegemony, is cracking. France and China just completed their first LNG trade settled in yuan. Not dollars, yuan. The United Arab Emirates is stockpiling gold and diversifying away from dollar reserves. Even traditional U.S. allies are hedging their bets. This isn't happening in some distant future. This is happening right now, today, while you're watching this video. And every time another country moves away from the dollar, every time another trade is settled in alternative currencies, every time another central bank buys gold instead of U.S. treasuries, the value of every dollar you own gets diluted just a little bit more. But here's where it gets really interesting. Because this isn't just about geopolitics. This is about mathematics. Cold, hard, undeniable mathematics. The U.S. government is currently spending about $2 trillion more per year than it takes in through taxes. $2 trillion, with a T, every single year. That deficit has to be financed somehow. And how do they finance it? By printing more dollars, by issuing more debt, by diluting the currency supply. Your savings account? It's being systematically devalued. Your retirement fund? Same thing. Every dollar you've worked for, every dollar you've saved, is worth less today than it was yesterday. And it'll be worth even less tomorrow. The official inflation rate might say 3% or 4%. But anyone who actually buys groceries, pays rent, or fills up their gas tank knows that's a joke. Real inflation, the inflation you experience in your daily life, is running far higher. And this is where gold and silver come in. Because unlike paper currency, you can't print more gold. You can't create it out of thin air with a keystroke. It has to be mined, refined, processed. It's finite, scarce, real. Throughout human history, Spanning thousands of years and hundreds of civilizations, gold and silver have been money, not because of tradition, not because of superstition, but because they possess the fundamental characteristics that make something valuable as a medium of exchange. They're durable, divisible, portable, and most importantly, they can't be arbitrarily inflated by governments. Every single fiat currency in human history has eventually failed. Every single one. The Roman denarius, the German papier mark, the Zimbabwean dollar, the Venezuelan bolivar, all of them collapsed to zero. The average lifespan of a fiat currency is around 27 years. The US dollar has been a pure fiat currency since 1971, when Nixon closed the gold window. Do the math. Now, I'm not saying the dollar is going to collapse tomorrow, but I am saying that the warning signs are flashing red, and the smart money, the institutional money, the central bank money, is already positioning for what comes next. Let me tell you about something that happened in 1971. Most people have no idea this even occurred, but it's arguably the most important economic event of the last century. Before 1971, the US dollar was backed by gold. If you had dollars, you could theoretically exchange them for physical gold at a fixed rate. This created discipline. The government couldn't just print unlimited money because they needed gold reserves to back it up. But by the late 60s, the US was spending massive amounts on the Vietnam War and domestic programs. They were printing more dollars than they had gold to back them up. Other countries started to notice. France, under Charles de Gaulle, started demanding gold for their dollars. Other nations followed. The US was facing a run on its gold reserves. So on August 15, 1971, President Nixon made an announcement that would change the world forever. He temporarily suspended the convertibility of dollars to gold. That temporary suspension is still in effect today, over 50 years later. And what happened next? The dollar lost over 98% of its purchasing power. Gold went from $35 an ounce to over $800 by 1980, then to over $1,900 by 2011, then to over $2,000 recently. But here's what most people miss. Gold didn't really go up. The dollar went down. Gold just maintained its purchasing power while the currency collapsed around it. An ounce of gold in 1971 could buy you a nice men's suit. An ounce of gold today can still buy you a nice men's suit. The gold didn't change. The dollar did. And we're seeing the exact same pattern play out again right now. Except this time, it's accelerating. The Federal Reserve's balance sheet has exploded from under $1 trillion before the 2008 financial crisis to over $8 trillion today. They've printed more money in the last 15 years than in the entire previous history of the United States combined. And they're not done. They can't be done. Because the system is built on debt. The entire modern financial system requires constant expansion of credit and currency to function. The moment they stop printing, the whole thing collapses. So they're trapped. They have to keep printing, which means they have to keep devaluing your savings, your purchasing power, your financial future, unless you own assets that can't be printed. Now here's something most people don't understand about the gold and silver markets, and this is crucial, because when you understand this, you'll see why the current prices are actually absurd. The paper gold market, gold futures, gold ETFs, gold certificates, is estimated to be anywhere from 100 to 250 times larger than the physical gold market. Let me say that again. For every ounce of physical gold that actually exists, there are potentially 250 paper claims on that same ounce. It's the biggest shell game in financial history. The COMEX, the major commodities exchange where gold futures are traded, has a tiny fraction of the physical gold needed to deliver on all the contracts they've sold. They're counting on the fact that most traders will just settle in cash rather than demanding physical delivery. But what happens when that changes? What happens when investors start demanding physical metal instead of paper promises? We've already seen glimpses of this. During the early days of the pandemic, physical gold and silver premiums exploded. You could buy paper gold at one price, but try to get physical metal delivered, and you'd pay 20, 30, even 40% more. The paper price and the physical price completely disconnected. That's not supposed to happen in an efficient market, but it did, because the paper market is a fiction. It's a price suppression mechanism that allows banks and governments to keep precious metals prices artificially low while they accumulate physical metal themselves. And speaking of accumulation, let me tell you what's happening in the silver market. Because if you think gold is interesting, silver is absolutely explosive. Silver is unique because it's both a monetary metal and an industrial metal. It's used in solar panels, electric vehicles, electronics, medical equipment, water purification. The industrial demand for silver is skyrocketing. But here's the problem. We're mining less silver now than we were a decade ago. Primary silver mines are declining. Most silver comes as a byproduct of copper, lead, and zinc mining, and those operations are slowing down. At the same time, investment demand is surging. Silver Eagle sales from the U.S. Mint hit record levels. Physical silver ETFs are seeing massive inflows. Retail investors are buying silver bars and coins at unprecedented rates. So you have declining supply, increasing industrial demand, and surging investment demand. Basic economics says price should be exploding, but it's not. Why? Because of that same paper market manipulation. The big banks can sell unlimited paper silver contracts to suppress the price. They don't need to have the physical metal, they just need to create the illusion of supply. But that game is ending. Because eventually, someone's going to call their bluff. Someone's going to demand physical delivery. And when they can't deliver, when the paper market finally breaks, the price of physical silver is going to do something that will shock the world. Some analysts are predicting silver could hit triple digits, not in 10 years. In the next major crisis. Because when the paper market breaks, when people realize that most of the silver they thought they owned doesn't actually exist, there's going to be a scramble for physical metal that will make the toilet paper shortage of 2020 look like a minor inconvenience. Now, let me address something important, because I know some of you are thinking, okay, this all sounds scary, but what am I supposed to do about it? I'm not a central bank. I don't have millions to invest. And that's exactly the point. You don't need millions. You need to start thinking differently about what money actually is. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. Covers how to get physical gold into your retirement account without tax penalties, how the process works, what the fees are, all of that. Worth checking out if that's relevant to your situation. Anyway, back to what you can do right now. The beauty of gold and silver is that they're accessible. You can buy a single silver coin for around $30 to $40. You can buy fractional gold coins. You can start small and build a position over time. But here's what you need to understand. This isn't about getting rich quick. This isn't about speculation. This is about preserving wealth. This is about having real assets when the paper system finally breaks down. Think of it as insurance. You have insurance on your house, right? You pay premiums every year hoping you never need it. But if your house burns down, you're damn glad you have it. Gold and silver are insurance against currency collapse, against inflation, against the systematic destruction of purchasing power that's been happening for decades. And unlike your house insurance, this insurance actually goes up in value over time. Let me tell you a story about what happened in Weimar Germany in the early 1920s. Most people know about the hyperinflation. Wheelbarrows full of cash to buy a loaf of bread, people burning money because it was cheaper than firewood. But here's what they don't tell you. The people who owned gold and silver survived. More than survived, they thrived. While everyone else's savings evaporated, while pensions became worthless, while the middle class was completely wiped out, the people who owned physical precious metals were able to preserve their wealth and even buy assets at fire sale prices. There were stories of people buying entire apartment buildings for a few gold coins, businesses for a handful of silver. Because while the paper currency was collapsing, gold and silver maintained their value. The same thing happened in Argentina, in Venezuela, in Zimbabwe, in every hyperinflationary collapse throughout history. The people who owned real assets survived. The people who trusted paper got destroyed. Now, I'm not saying we're heading for Weimar-style hyperinflation tomorrow, but I am saying that the conditions are eerily similar. Massive government debt, central bank money printing, loss of confidence in the currency, geopolitical instability, and the smart money is already positioning for it. Here's something else that should concern you. The banking system itself is far more fragile than most people realize. Remember Silicon Valley Bank, Signature Bank, First Republic? These weren't small community banks. These were major institutions that collapsed almost overnight. And why did they collapse? Because they were holding long-term bonds that lost value when interest rates went up. Because they were playing games with depositor money. Because the system is built on leverage and confidence, and when confidence breaks, everything falls apart. And here's the scary part. Those banks were relatively healthy compared to some of the major institutions. The derivatives exposure of the big banks, JP Morgan, Bank of America, Citigroup, is measured in the hundreds of trillions of dollars. That's not a typo. hundreds of trillions. If there's another financial crisis, if those derivatives start unwinding, the government will have to print money on a scale that makes the pandemic response look like pocket change. And every dollar they print dilutes your savings even further. But gold and silver? They're not someone else's liability. They're not dependent on a bank staying solvent. They're not tied to the health of the financial system. They're real, tangible assets that you can hold in your hand. Let me talk about something that's happening right now in the physical gold market that should be setting off alarm bells everywhere. The London Bullion Market Association, the LBMA, is the center of the global gold trade. It's where the big banks, the central banks, the major institutions trade physical gold, and their vaults are being drained. Gold is flowing out of London and heading east, to China, to India, to Singapore. The western vaults are being emptied while eastern vaults are being filled. This is a massive wealth transfer that's happening in real time. The West is selling paper gold while the East is buying physical gold. And when this process completes, when the West has sold off its physical reserves and is left holding paper claims, the balance of financial power will have shifted permanently. China has been accumulating gold for years. They don't report their full reserves. Nobody knows exactly how much gold China actually has. But estimates range from 10,000 to 30,000 tons, maybe more. Why would China be accumulating gold on this scale? Because they're preparing for a world where the dollar is no longer the dominant reserve currency. They're preparing for a world where gold backs trade settlements, where real assets matter more than paper promises. And they're not alone. Russia has been buying gold aggressively. India's central bank is buying. Poland bought 100 tons in a single year. Singapore is building up reserves. Even Hungary, a small European nation, has increased its gold reserves tenfold. These aren't random decisions. This is a coordinated move away from dollar dependence and toward hard asset reserves. And while all this is happening, what is the average American doing? Sitting in cash, sitting in bonds, sitting in paper assets that are being systematically devalued. Here's another thing most people don't realize. The gold mining industry is in serious trouble. Gold production peaked around 2018 and has been declining since. The easy gold has been mined. The high-grade deposits are depleted. What's left requires more energy, more capital, more time to extract. And it's getting worse. The average grade of gold ore has been declining for decades. Miners are processing more and more rock to get the same amount of gold. This means higher costs, lower margins, and less incentive to develop new mines. At the same time, it takes anywhere from 7 to 10 years to bring a new gold mine online. From discovery to production is a decade-long process requiring billions in capital investment. So even if gold prices spike, even if demand explodes, supply can't respond quickly. The gold that exists today is basically all the gold we're going to have for the next several years. This creates a supply-demand dynamic that's incredibly bullish for prices. Declining supply, increasing demand, and no way to quickly increase production. It's the perfect setup for a price explosion. And silver is even worse. Silver mining is declining faster than gold. The silver-to-gold ratio, which historically averaged around 15 to 1, is currently around 80 to 1, meaning silver is dramatically undervalued relative to gold. When that ratio reverts to historical norms, and it will, it always does, silver prices are going to move in ways that seem impossible right now. Let me tell you about something called Gresham's Law. It's an economic principle that states bad money drives out good money. What this means is that when you have two forms of money in circulation, people will hoard the good money and spend the bad money. They'll hold on to gold and silver and spend paper currency. We're seeing this play out right now. People are accumulating physical precious metals while spending their dollars, because instinctively, people understand that real assets are more valuable than paper promises. This creates a feedback loop. As more people hoard gold and silver, physical supply becomes tighter. As supply tightens, premiums increase. As premiums increase, more people want to buy before prices go higher, and the cycle accelerates. We saw this in the 70s. We saw it in 2008 through 2011, and we're seeing it again now. Except this time, the underlying fundamentals are far worse. The debt is higher. The money printing is more extreme. The geopolitical tensions are more severe. The loss of confidence in institutions is more widespread. This isn't just another cycle. This is a structural shift in how the world thinks about money and value. Now let me address something that the mainstream financial media loves to bring up. Gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And they're right. Gold doesn't pay dividends. But you know what else doesn't pay dividends? Cash. Your savings account. And unlike cash, Gold doesn't lose value through inflation. The question isn't whether gold generates income. The question is whether it preserves purchasing power. And the answer, over thousands of years of human history, is an unequivocal yes. Would you rather own an asset that pays you a 3% dividend while losing 5% to inflation? Or would you rather own an asset that pays no dividend but maintains its purchasing power? The math is pretty simple. And here's something else. In a real crisis, in a real currency collapse, the ability to generate paper currency income becomes meaningless. What matters is having real assets that hold value. During the Great Depression, people who owned gold could buy assets at pennies on the dollar, farms, businesses, real estate. Because while everyone else was desperate for cash, they had real money. The same thing will happen in the next crisis. The people who own physical gold and silver will be able to acquire assets at generational lows. While everyone else is scrambling to survive, they'll be building wealth. Let me talk about something that's happening in the retail investment space that's absolutely fascinating. There's been an explosion in retail demand for physical silver, not paper silver, not silver ETFs, physical coins and bars. Online dealers are reporting record sales. Mints around the world are struggling to keep up with demand. Premiums on physical silver have been elevated for years now. This is a grassroots movement. Regular people, not institutions, are buying physical silver in quantities that are starting to matter. And they're not selling, they're holding. This is creating a situation where physical silver is being removed from the market permanently. It's going into private hands and staying there. And every ounce that gets removed makes the remaining supply that much tighter. There's a term for this: strong hands. These are investors who aren't trading. They're not trying to flip for a quick profit. They're accumulating and holding for the long term. And when you have strong hands accumulating a finite asset, prices eventually have to rise. It's not a matter of if, it's a matter of when. The paper market can suppress prices for a while, but eventually physical demand overwhelms paper manipulation. And when that happens, prices don't just rise, they explode. We saw this with palladium a few years ago. The paper market kept prices suppressed while physical demand was surging. Then suddenly the paper market broke, and palladium went from $600 to over $3,000 in less than 2 years. Silver is setting up for the same kind of move, except the silver market is much bigger, much more important, and much more manipulated. When it breaks, the move is going to be historic. Here's something that should terrify anyone holding significant wealth in traditional assets. The correlation between stocks, bonds, and real estate is increasing. It used to be that when stocks went down, bonds went up. Diversification worked. But in recent years, we've seen stocks and bonds fall together. Real estate is tied to interest rates, which affects both stocks and bonds. Everything is correlated now because everything is tied to the same thing: central bank policy. When the Fed prints money, everything goes up. When they tighten, everything goes down. Except gold and silver. They're negatively correlated to the dollar and to confidence in the financial system. When everything else is falling apart, precious metals shine. This makes them the ultimate diversification, not because they're going to make you rich, but because they're going to protect you when everything else fails. And make no mistake, everything else will fail. Maybe not tomorrow, maybe not next year. But the current system is mathematically unsustainable. The debt can't be repaid, the promises can't be kept, the currency can't maintain its value. Something has to give, and when it does, you want to be holding real assets. Let me paint you a picture of what the next few years might look like. The government continues to run massive deficits. The Fed continues to print money to finance those deficits. Inflation remains elevated, despite official statistics claiming otherwise. More countries move away from the dollar for international trade. The BRICS nations launch their alternative payment system. Saudi Arabia expands oil sales in non-dollar currencies. Confidence in the dollar gradually erodes, not all at once, slowly, like water dripping on stone. Then something breaks. Maybe it's a major bank failure. Maybe it's a sovereign debt crisis. Maybe it's a geopolitical event. But something triggers a loss of confidence, and suddenly everyone wants out of dollars and into real assets. Gold and silver prices spike, but you can't get physical metal. Dealers are sold out. Premiums are 50, 70, 100% over spot price. The paper market breaks. COMEX defaults on physical delivery. The price of paper gold and physical gold completely disconnect. Governments try to control the situation. Maybe they restrict gold ownership. Maybe they impose capital controls. Maybe they launch a new digital currency. But it doesn't matter. Because the people who own physical gold and silver, who have it in their possession, who control their own wealth, they're protected. This isn't science fiction. This is a scenario that's played out repeatedly throughout history, and it's setting up to happen again. The question is, are you going to be prepared? Or are you going to be one of the people scrambling to protect your wealth after it's too late? Because here's the thing about insurance. You can't buy it after the house is already on fire.